What determines interest rates? Or more importantly, what determines your interest rate or my interest rate? But before we get into what determines your rate or my rate, I want to talk about interest rates in general. Why are rates what they are? The reason why rates are what they are is usually due to inflation from months prior, right? So what do I mean by that? Well, in 2020, rates were at an all-time low in the 2%, right? Unheard of. But the lower interest rates are, the more money that is being lent out to the general public, the more money being lent out, the more money people have in their pockets, and the more money they have in their pockets, the more buying power they have. And when consumers have buying power, these companies are going to be increasing the costs of their goods and services because they know people can afford it, right? So costs will start going up the lower interest rates are. Inversely, the higher rates are, the less buying power people have and the less these costs of goods and services will be. So what do I mean by that? The higher interest rates are, the less money being lent out to the general public, the less money people have, the less buying power people have. And when people can't buy goods and services, these companies have no choice but to either stop these costs from going up or to lower costs in general. So that's what the feds are looking to do with increasing interest rates is they're trying to lower these inflation numbers and lower the cost of these everyday goods and services like groceries and gas and food, things like that, right? So that's why rates are what they are. It's usually based on inflation numbers from the months prior, right?
What determines your specific rate? There's several different factors that we look at when determining your individual interest rate. We first look at your credit score. So this establishes your credit worthiness, also known as how likely are you to pay back borrowed money. Super important when we are talking about interest rates. The other thing that we look at is your loan amount and LTV. LTV is a loan to value ratio. It basically looks at how much is your loan amount versus how much is the property appraised for. Another way to explain this is how much of the property do you own versus how much do you have in your mortgage. For example, if your LTV ratio is 80%, that means that 20% of the home is yours. You paid cash for it. 80% is in your mortgage. So to round that out, the more that money that you put down, the lower your loan amount and LTV. Typically, the lower your LTV, the more likely it is that you have some flexibility in your interest rate. The next thing that we look at is what type of loan you're getting and what type of property that loan is for. So you could be getting a conventional loan for a single family property. You could be getting a construction loan. Maybe you're getting an investment loan for an investment property that's a quadplex. All those different combinations can kind of establish the riskiness of loaning you money, which can also increase or decrease your interest rate. So all of these factors make up what we call your credit profile. Once we kind of look at all these factors, determine, your credit profile status, we then want to see what type of loan is best for you, especially if you qualify for more than one, which a lot of people do. For example, the most common, qualifications we look at is comparing FHA rates and costs to conventional rates and costs. And we want to look at the full picture for you. We want to look at your credit profile. It's super important, but we also want to look at your financial status as a whole. We want to make sure that we're shopping the best rate for you and establishing the best course of action as a whole for you to be in the home you want to be in.
So the cost of your interest rate is based on what's going on in the market. Stocks and bonds are traded all the time. You hear about that regularly, right? And when the market opens in the morning, your loan, your interest rate may cost this. Later in the day, it may be here. Later in the day, it may be here. That's just the nature of the game. That's our job as the loan officers to pay really close attention to what's going on in the market and to lock in the rate, which really is just locking in the pricing of all of those factors that go into your loan. We lock in that pricing at that specific time. So we're locking in the cost of your rate when we lock your rate. Once we know all those factors, all those things that are in your credit profile, even though those things won't change, the market may change. So that may mean that your interest rate might change. So when Alex was talking earlier about inflation and the Fed changing rates and all that sort of thing, those are the things that go into the market changing. All the different lenders that we work with, they have their own pricing policies as well. So if they see, oh, the Fed did this, or Powell said that, then maybe they are going to tighten up their pricing. Or maybe they haven't been getting a lot of business lately and they really want more FHA loans, so they're going to be more aggressive on pricing for FHA. There's all those different things that go into it, and it's our job as loan officers to not only watch the market and see what the predictions are of what's going to happen, but to also know this lender likes this type of loan and this lender likes this type of loan, and to stay up on all of that so that we can be the best service provider for all of our clients. A couple other things that go into pricing that you may not be aware about. You do often have the option to not only pay points and buy down your interest rate to get a lower rate. Typically, that's going to mean having more cost and more fees up front. But you also often have the opportunity to do the opposite. Take a higher interest rate and get a lender credit to cover some of your closing costs. So maybe it's been a really tight market and you couldn't get any seller concessions to cover closing costs, but you don't have quite enough money saved up to cover your down payment and all of the closing costs. If you take a slightly higher interest rate, you can often, depending on, of course, what's going on in the market and how everything is priced, you can often get a lender credit to cover some of those costs. So talk with your loan officer about those options. Also, really important to remember, the interest rate that you secure on your loan does not necessarily mean you got a good loan or a bad loan. A high rate does not necessarily mean you got a bad deal. A low rate does not necessarily mean you got a good deal. Really important to look at all the cost that is associated with that loan. Costs do matter. It's not all about rate. We all know we're not paying our interest rate every month to the mortgage lender. We're paying our payment. So when we are qualifying people, we are looking at what sort of mortgage payment are you comfortable with every month? That is one of the very first questions I always ask everyone. What payment fits in your budget? And what is the payment that is that stretch payment that you really don't want to make? If the house is perfect, you'd be happy to stretch your budget there. Those are the kind of things that we need to ask to make sure everybody's really comfortable with what they're buying, not only the house, but also the loan that they're getting. So this is what we have to share about interest rates today. If you have any questions, please leave us comments. Please reach out. We want to be your resource. We want to be here to help you.